Welcome to the Deep Dive. Today we are slicing right into the heart of the global food industry.
We are. We're looking at a major branded food company that just wrapped its fiscal year 2025.
And the results gave us this really clear but sometimes contradictory picture of its financial health.
And a very bold strategic outlook for 2026. It's almost like a classic business school case study, but it's unfolding in real time.
It really is.
I mean, you have a company that successfully delivered, what was it, $12.1 billion in net sales?
$12.1 billion. And on top of that, they managed to get 4 consecutive quarters of strong, organic, top-line momentum.
Right. 4 quarters. That is just relentless sales execution.
It sounds like a decisive win, and yet the company itself described its overall earnings and profitability for the year with just one word.
Disappointing.
That's a huge disconnect, a massive disconnect. Our sources are telling this tale of incredible top-line success that was just completely derailed by margin pressure.
Absolutely. So our mission today is to figure out the specifics. Why was the sales engine running so hot while the profit engine, seized up?
Exactly.
We need to analyze the major headwinds, from commodity costs to internal operational snags that really crush the bottom line.
And then we have to scrutinize the concrete, actionable steps they're taking now to make sure that this projected profitable growth in fiscal 2026 actually happens.
It's all about making sure it materializes.
So let's start by acknowledging that success.
Yeah.
FY 2025 delivered 2.5% full-year organic net sales growth.
Which is impressive. And what makes it really impressive is that this momentum wasn't just in one area.
Right, it wasn't isolated.
No. It was supported by every single one of their reporting segments: retail, food service, and international.
That kind of widespread growth, it really demonstrates the power of their core portfolio, doesn't it?
It does. It shows the strength of that protein-centric portfolio.
About.
But maintaining that growth was incredibly expensive this past year.
Why was that?
Because the macro environment was just relentlessly hostile.
Yeah.
The major headwind was elevated input costs.
Oh.
And those were almost entirely driven by these persistently high global commodity costs, which just forced margin compression across the board.
And it wasn't just the global market factors hitting them. I saw they also faced some distinct internal and operational issues.
Which is often a double whammy when margins are already that tight.
Right.
Precisely. They cited isolated operational incidents. This included significant problems related to avian illnesses.
Oh, wow.
So we're talking about challenges that affect their crucial turkey portfolio.
Yeah.
And then there was a specific, very costly chicken product recall that they called out in the food service segment results.
And those kinds of things, they don't just impact one quarter, do they?
No, not at all. They disrupt the entire supply chain. They increase operational costs. They can erode customer confidence. It all accumulates very quickly when you're trying to defend a thin margin.
Okay, here's where we need to dive into the financial cleanup, because I think this is the key to understanding the full scope of that disappointment they mentioned.
I agree.
If you look at the company's stated GAAP operating income, that's generally accepted accounting principles, it absolutely cratered in the fourth quarter.
It's a shocking number.
It went from $294 million in Q4 of 2024 down to just $2 million in Q4 2025.
$2 million. That drop is the central paradox here. It screams financial crisis.
It does.
But you have to look deeper. You have to get into the footnotes. And that leads us straight to the $234 million in total non-cash impairment charges they recorded in Q4.
Okay, so these are accounting adjustments.
Exactly. It's a way of writing down the value of assets that they've determined are no longer worth what they're carrying on the books.
So if that $234 million charge is, non-cash and it's non-recurring, how do we use these financial statements to figure out the true health of the ongoing business?
That is the million-dollar question, right?
Yeah.
And that's exactly why the company, and really any analyst looking at them, will focus on what's called non-GAAP adjusted profitability.
Okay, so they're separating things out.
Precisely. GAAP gives you the full official picture. It has to include all the bad news, all the cleanups.
The whole story?
The whole story. But non-GAAP figures, they let you strip out those one-time non-cash charges like this massive impairment, along with any restructuring costs.
So you're left with just the core operational performance.
Exactly. By focusing on non-GAAP, you're looking at the profitability generated by the core operations after you factor in inflation, but before you factor in all that balance sheet cleanup.
Got it. And that non-GAAP figure is what shows us the underlying resilience of the business itself.
That's the number that tells the real story.
So what did that impairment charge actually relate to? I mean, $234 million is a huge number for a cleanup.
It is, and it signals a correction of, let's say, past strategic missteps. The charge is related primarily to two areas: a minority investment in the international segment, specifically Indonesia, and certain intangible assets within their retail segment.
So writing those down basically indicates they realized the future returns from those ventures just weren't going to materialize.
That's it. They're using 2025 as the year to take the pain, clean the slate, and then move forward with a much more focused approach.
Speaking of focus, let's look at what this company actually sells, because their extreme concentration in protein is key to both their success and, I think, their vulnerability.
Absolutely. They are a global branded food leader in over 40 categories.
So what's the breakdown?
Their structural breakdown is really informative. Retail accounts for the largest share, that's 62% of net sales. Food service is substantial at 32%, and then international is about 6%.
But the real pressure point is their input mix, isn't it?
That's it. Pork dominates at around 45% of their total input mix.
Oh, wow, almost half.
Almost half. Then you have turkey and beef, both around 15%, and then non-meat inputs make up the last 20%.
That means if global pork prices surge, almost half their entire cost of goods sold is under immediate acute pressure. It must be hard to pass that kind of increase through to the consumer without sacrificing volume.
Exactly. Which, it makes their segment success this year even more remarkable.
So let's talk about that. Food service was the strongest performer, showing 5.5% organic net sales growth for the full year.
A very resilient segment.
So why did food service outperform retail during this really inflationary period?
Because food service focused heavily on value-added, customized, and solutions-based products.
What does that mean in practice?
Well, think about branded bacon offerings, like their Bacon One product, or branded pepperoni, premium prepared proteins. These are high-margin, consistent items demanded by restaurants and institutions.
So they're selling solutions, not just commodities.
Exactly. And that strategic focus gave them pricing power, even though their food service profits still took a hit in Q4 from that chicken recall and the high commodity costs.
Right. Now, on the retail side, growth was a little more modest, up 1.1%. What was driving growth on the grocery store shelves?
There, the strengths came from their flagship products. The volume and sales gains were driven by the Jennie-O Turkey portfolio, Planters Snack Nuts, which is a powerhouse brand, and then Applegate products.
Which caters to that premium natural segment.
It does. And they did partially offset this growth by discontinuing some lower-margin private label snack nuts.
Another sign of that strategic pruning.
Another sign.
Okay, and international, their smallest segment, still managed 1.1% organic growth for the year. I imagine their growth drivers there are pretty iconic.
They absolutely are. International strength was built on the legendary Spam luncheon meat.
Of course.
It saw annual volume and net sales growth. And then their refrigerated portfolio with a strong contribution from the China market in Q4.
But it wasn't all smooth sailing there either.
Not at all. That momentum was severely hampered at the end of the year by declines in fresh pork exports and some pretty intense competitive price pressures in places like Brazil.
So, given all these overarching cost pressures and operational issues, they have this internal efficiency program running. Transform and Modernize, or T&M.
Yes.
This initiative must be crucial for them to find internal savings to counteract all that external inflation.
T&M is the company's biggest lever of internal control. It's a multi-year, long-lasting effort to build new capabilities.
And it's working.
It seems to be. We know it delivered over $120 million in value in 2025, which was within their stated range. That's a pretty significant achievement given the environment.
And it's not just about cutting costs, right?
Not at all. It focuses on three pillars: optimizing the supply chain and manufacturing, streamlining their network and portfolio, and then upgrading processes, data, and talent.
So when they say supply chain optimization, what does that actually look like on the ground to deliver $120 million in value? Is it, new software or closing inefficient plants?
It's a bit of both, but fundamentally it's about reducing waste and complexity. For example, modernizing processes might allow them to reduce ingredient loss or streamline their logistics routes.
And the network optimization.
That might involve consolidating production lines or just better utilizing capacity across their many facilities, making sure that their high-volume, high-margin products, like those food service solutions we talked about, are made with the lowest possible cost structure.
It's the critical offset against those high commodity prices.
It has to be.
Okay, so moving into fiscal 2026, the company has announced what they call a clear strategic compass. committed to reshaping its earnings trajectory.
Right. They proved they could grow sales in 2025. Now, the entire mission is converting that sales volume into robust profit in 2026.
And the strategy seems highly focused, broken down into three core areas. What's the first one?
The first is consumer obsession, which, means moving beyond just selling meat products. It's about designing convenient, protein-centric solutions and experiences for specific food occasions.
Like easy weeknight meals or unique ingredients for restaurant partners.
Exactly. Then the second pillar is beyond boundaries, which is about leveraging that protein advantage to unlock new growth and marketplace opportunities.
So product innovation, geographic expansion, that kind of thing.
Yes, but it's the third pillar, future ready, where the immediate restructuring is happening.
Okay.
This is about simplifying the company structure. They started a corporate restructuring plan in Q4 of 2025, specifically to reduce administrative expenses and overhead.
And they used a crucial phrase that portfolio reshaping is a priority.
It is a priority, and we already have a tangible example of this reshaping, which really signals their intent to cut what doesn't fit that protein-centric future.
And that's the sale of the Justin's branded business.
That's right. The sale of Justin's, known for its specialty nut butters, is expected to close in Q1 of 2026. And this divestiture is actually already factored into their non-GAAP organic net sales calculations for the 2026 outlook.
What's the strategic implication of selling Justin's? I mean, it's a really well-known brand.
It is, but it's a clean signal. Justin's is a high-quality product, but it's non-core to their main protein focus of pork, turkey, and beef. It also likely operates at a different scale and margin profile than their massive integrated operations that support SPAM or Jennie-O.
So selling it lets them redeploy that capital and management time.
Immediately, away from a lower-scale non-core asset and into their highest growth, highest margin, protein-centric areas.
Now, while they're going through all this strategic pivoting and financial cleanup, they've maintained this steadfast commitment to their shareholders. They're what's known as a dividend aristocrat.
That is a critical status for them. To be a dividend aristocrat means they've increased their dividend payout for a minimum of 25 consecutive years.
And they just did it again.
They did. In fact, they just announced their 60th consecutive annual dividend increase,
60 years.
raising the annualized rate to $1.17 per share.
60 years. What does that kind of longevity tell you about the business, especially when we just discussed their painful Q4 profit figures?
It speaks volumes about management's confidence in their operational cash flow stability, even during periods of earnings volatility like this.
It's a signal to the market.
It is. It signals that while 2025 was a year for margin repair and balance sheet cleanup, they believe the underlying engine, the strength of brands like SPAM, is fundamentally sound.
Sound enough to generate the cash needed to sustain and grow that dividend for decades.
Absolutely. And that legacy alone puts significant pressure on them to deliver the profit targets they've now set for themselves.
So let's talk about those targets. What does all this aggressive restructuring and focus translate to in concrete numbers for 2026?
Well, they introduced guidance that they described as achievable and realistic, and it predicts a major rebound.
Okay.
They expect net sales in the range of $12.2 billion to $12.5 billion. That means organic growth of 1% to 4%.
But the crucial rebound is in profitability.
That's the key. Adjusted operating income is expected to hit between $1.6 billion and $1.12 billion.
Which translates to robust growth of 4 to 10% year over year.
Yes. And adjusted diluted EPS is targeted for similar growth, $1.43 to $1.51 per share.
And if we dig into the segment expectations that underpin this growth, food service is expected to lead the charge again.
Mid-single-digit net sales growth. But interestingly, international is projected for the highest net sales growth. High single digits, but on only low single-digit volume growth.
What does that imply?
That implies significant price realization. It suggests they expect to successfully pass through more costs or maybe pivot to higher margin products in those key markets, like China.
And retail.
Retail, while seeing some modest volume declines, is still expected to achieve low single-digit organic net sales growth. It just proves the resilience of those core brands like Planters and Jennie-O.
What's fascinating to me here is the timeline for the recovery. They didn't claim it's going to be immediate.
No, they were very careful.
They explicitly warned of continued earnings pressure in the first quarter of fiscal 2026.
Right. The full force of that 4 to 10% profit growth is not instant. They anticipate the real profit growth will follow in the rest of the year.
And that warning suggests they're still absorbing high commodity costs and the immediate costs from the restructuring.
It does. It's a staggered recovery, built on the assumption that those T&M cost savings start to accelerate throughout the year.
Which brings us to, I think, the biggest assumption underpinning their entire financial forecast for 2026.
They need the market to cooperate.
They absolutely do. Their outlook explicitly assumes a modest improvement in most commodity markets during the second half of the year compared to the pain they felt in FY 2025.
They do acknowledge costs will still be above historical levels, but they absolutely need that moderation to hit their margins.
So this raises a really important question for you to consider, and it's the main risk factor for their 2026 target.
That 4 to 10% profit growth, it relies on two crucial things working perfectly.
The first being the internal one.
Right. T&M generating those accelerating internal efficiency gains.
And the second.
The external one. That global pork, turkey, and beef commodity prices softened significantly after the first half of the year.
So if the market doesn't play nice, if global inflation remains stubbornly high, or if some geopolitical event spikes protein prices again, how much of a cushion has that $120 million plus in T&M efficiency really given them?
That's the question. Is T&M robust enough to cover that kind of external volatility? Or is their profit recovery still essentially a bet on a softer commodity environment in Q3 and Q4?
That gap between internal control and external factors?
That internal versus external control gap is the key challenge for them moving forward. They control the pace of restructuring and efficiency, for sure, but they absolutely do not control the pace of inflation.
So the success of 2026 will be defined by their ability to execute that tight focus.
Divesting non-core assets like Justin's, driving the T&M benefits, maintaining pricing power through their beloved brands, all while navigating these highly volatile global input markets.
So to summarize, this deep dive shows a major food company that successfully proved the durability of its $12.1 billion sales base in 2025.
Powered by those iconic brands like Spam and Planters.
But profitability was just crushed by global commodity inflation and a really painful internal financial cleanup.
Marked by that huge $234 million impairment charge.
Fiscal 2026, then, is fundamentally the margin recovery year. It's focused on converting those sales into profit via aggressive optimization and some portfolio trimming.
The path forward is clear. Focus on premium protein solutions, streamline operations through T&M, and divest the non-core brands. But the entire trajectory, it all hinges on the operational success of their efficiency programs and that crucial assumption that global commodity markets cooperate in the back half of the year.
And that dependency on external factors, despite all the internal strategic action, is a fantastic place to leave this for you to consider. Thanks for joining us on The Deep Dive.